What if your investments paid you like a paycheck, every single month, even in chaotic markets? They can. Today, we'll explore REITs, real estate investment trusts, that can create reliable monthly income, and the risks you must understand before investing. REITs, real estate investment trusts, are companies required by law to pay out at least 90% of their taxable income as dividends. That's why they're attractive for passive income. These companies own or finance apartments, office buildings, and more, so you can earn steady income without being a landlord. But there are risks you need to know. Next, we'll break down how monthly payouts work and what to watch for step by step. Real estate investment trusts, or REITs, are a unique way for everyday investors to access the income and growth potential of real estate, without the need to buy or manage properties directly. REITs generate income by either owning or financing real estate assets. There are two main types: equity REITs, which own and operate income-producing properties, and mortgage REITs, which invest in real estate debt and earn interest from mortgages and loans. Equity REITs are the most common, and they focus on sectors like industrial warehouses, healthcare facilities, and residential apartments, providing steady cash flow from rent collected on these properties. By law, REITs must distribute at least 90% of their taxable income to shareholders as dividends, making them a popular choice for those seeking regular income. This structure allows investors to benefit from real estate's income potential, while enjoying the liquidity and simplicity of trading shares on the stock market. Let's look at a real-world example. Realty Income, often called the Monthly Dividend Company, is a well-known REIT that pays investors every single month, not just quarterly like most stocks. This monthly payout schedule is designed to mimic the regularity of a paycheck, making it easier for investors to budget and plan their finances. For retirees or anyone relying on investment income, this predictability can be a game changer. Monthly dividends also allow for more frequent reinvestment, which can accelerate compounding over time. In addition, companies like Realty Income have a long track record of consistent payments, which helps build trust and confidence among shareholders. When evaluating monthly dividend REITs, it's important to look at their history of payments, dividend growth, and the stability of their underlying properties. Monthly payouts can significantly reduce financial anxiety because you see income arrive frequently, even if the annual total matches a quarterly schedule. It's the regularity that matters for peace of mind. For many investors, knowing that cash flow is coming in every month helps with budgeting for bills, living expenses, or even reinvesting for future growth. This steady stream of income can be especially valuable during periods of market volatility, when other investments may fluctuate in value. The psychological benefit of frequent payments shouldn't be underestimated. It can help investors stay disciplined and avoid emotional decisions during market swings. In addition, monthly dividends can be automatically reinvested through a dividend reinvestment plan, or DRIP, allowing your investment to grow over time without any extra effort. However, it's important to understand the risks. REITs are sensitive to changes in interest rates. When rates rise, the prices of REIT shares can fall, even if the underlying rents and dividends remain steady. This is because higher interest rates can make alternative income investments, like bonds, more attractive, and can also increase borrowing costs for REITs themselves. That's why diversification across different real estate sectors, such as retail, industrial, healthcare, and residential, is key to managing risk. By spreading your investments across multiple types of REITs, you can reduce the impact of sector-specific downturns and interest rate fluctuations. It's also wise to monitor the overall economic environment, as factors like inflation and employment trends can influence real estate values and rental income. To evaluate the health of a REIT, focus on two key metrics: funds from operations, or FFO, and adjusted funds from operations, or AFFO. These measures show the real cash flow generated by the REIT's properties, excluding non-cash accounting items like depreciation. FFO and AFFO provide a clearer picture of a REIT's ability to pay dividends sustainably. It's also important to look at the payout ratio, which tells you what percentage of cash flow is being distributed to shareholders. A sustainable payout ratio is usually below 80%, leaving room for reinvestment and unexpected expenses. Don't be swayed by headline yields alone. High yields can sometimes signal risk if they're not supported by strong cash flow. Instead, focus on REITs with a track record of stable or growing dividends, conservative payout ratios, and diversified property holdings. For example, a REIT with a 75% payout ratio is likely more sustainable than one paying out nearly all its cash flow. This cushion allows the company to weather downturns, invest in property improvements, and maintain dividend payments even if rental income temporarily dips. Before investing, always check these numbers in the company's financial reports and compare them to industry averages. Look for consistency in payout ratios over time, as sudden increases may indicate trouble ahead. It's also helpful to review management's commentary on dividend policy and future growth plans. Remember, a sustainable dividend is more valuable than a high but risky payout. By focusing on quality and stability, you can build a portfolio that delivers reliable income year after year. Most REIT dividends are taxed as ordinary income, which means they may be subject to higher tax rates than qualified dividends from other stocks. To maximize your after-tax returns, consider holding REITs in tax-advantaged accounts, such as IRAs or 401(k)s. This strategy allows your dividends to grow tax-deferred or even tax-free depending on the account type. It's also important to keep good records of your REIT investments, as tax reporting can be more complex than with traditional stocks. Some REITs may also pay out a portion of their dividends as return of capital, which can have different tax implications. Consult a tax advisor if you're unsure how REIT income will affect your personal tax situation. By planning ahead, you can keep more of what you earn and avoid surprises at tax time. Now, let's look at portfolio strategies for REIT investors. A simple, effective approach is to combine a core REIT ETF, which provides broad diversification, with one or two individual monthly paying REITs for extra yield. You might also add a specialty REIT, such as those focused on data centers or healthcare, to capture growth in specific sectors. Always size these positions conservatively so that no single REIT dominates your portfolio. Rebalancing periodically ensures that your allocation stays in line with your goals and risk tolerance. It's also wise to review the underlying holdings of any REIT ETF to avoid unintended concentration in certain sectors or geographic regions. By building a balanced mix, you can enjoy the benefits of steady income, diversification, and long-term growth potential. Once you've built your REIT portfolio, decide how you want to handle your dividends. Reinvesting with a dividend reinvestment plan, or DRIP, allows your income to compound over time as each payment buys more shares and increases future payouts. Alternatively, you can take monthly cash if your goal is to supplement your living expenses. The key is to make this decision upfront, based on your personal needs and financial plan. Review your strategy regularly, especially if your circumstances change. Many brokerages offer automatic DRIP enrollment, making it easy to grow your investment passively. If you choose to take cash, set up a system to track your monthly income and ensure it aligns with your budget. Consistency and discipline are essential for long-term success. To stay on track, enable dividend alerts with your brokerage, set up auto-invest for DRIP, and check the health of your REIT payouts every quarter. Consistency and discipline are key to building reliable passive income. Regularly reviewing your portfolio helps you spot potential issues early, such as declining dividends or changes in property values. It's also a good idea to read company filings and earnings reports so you understand how your REITs are performing. By staying informed and proactive, you can make adjustments as needed and avoid unpleasant surprises. Remember, building wealth with REITs is a marathon, not a sprint. Steady progress and careful monitoring will help you reach your goals. Here's an illustration. Imagine a portfolio with 50% in a diversified REIT ETF, 30% in a monthly payer, and 20% in a specialty sector REIT. This mix provides broad exposure, regular income, and the potential for growth in emerging areas. To make your income tangible, convert yields into dollars per month, rather than focusing on percentages. Track your progress monthly, not daily, to avoid getting caught up in short-term market noise. Over time, this approach can help you build a reliable stream of passive income that supports your financial goals. Adjust your allocations as needed, based on changes in the market or your personal situation. The key is to stay flexible and focused on the long term. With the right mix of REITs and regular portfolio reviews, you can create a steady, predictable income stream, regardless of what the broader market is doing. Remember to focus on quality, sustainability, and diversification, rather than chasing the highest yields. By following these principles, you'll be well positioned to enjoy the benefits of monthly dividends and the long-term growth potential of real estate investing. When investing in REITs, it's easy to be tempted by the highest yields, but chasing yield without understanding the underlying risks can lead to disappointment. Many investors overlook payout sustainability, focusing only on the advertised dividend rate. This can be a costly mistake, especially if the company is overextending itself to maintain those payouts. For example, a REIT offering a double-digit yield may be dipping into reserves or taking on excessive debt, which isn't sustainable in the long run. Another common pitfall is concentrating your investments in a single sector, like retail or office space, without considering how economic shifts can impact those areas. Diversification is essential to weather downturns in any one segment. Some investors also ignore the importance of payout ratios, missing early warning signs that a dividend may be at risk. If a company's payout ratio is consistently above 100%, it's a red flag that the dividend could be cut. It's also important to look beyond the headline numbers and examine the company's financial statements for clues about future performance. For instance, declining funds from operations or rising debt levels can signal trouble ahead. By being aware of these common mistakes, you can avoid costly errors and build a more resilient portfolio. Now, let's transition to how you can construct a balanced REIT portfolio that manages these risks effectively. Building a balanced REIT portfolio starts with diversification. Instead of putting all your money into one type of REIT, consider spreading your investments across different sectors, such as industrial, healthcare, residential, and specialty REITs. For example, a well-constructed portfolio might include 50% in a diversified REIT ETF, 30% in a monthly payer like realty income, and 20% in a specialty sector such as data centers or infrastructure. This approach helps smooth out income and reduces the impact of sector-specific downturns. Diversification also means considering both equity and mortgage REITs as they respond differently to changes in interest rates and economic cycles. By blending these types, you can create a more stable income stream. It's also wise to periodically rebalance your portfolio, adjusting your allocations as market conditions and your personal goals evolve. Remember, the goal is to achieve steady, predictable income, not to chase the highest possible yield. By focusing on balance and sustainability, you can build a portfolio that supports your financial objectives over the long term. Next, let's explore how reinvesting dividends can further enhance your returns. Reinvesting dividends through a dividend reinvestment plan, or DRIP, allows your income to compound over time. Instead of taking cash payouts, your dividends are automatically used to purchase additional shares, increasing your future income potential. This strategy is especially powerful for long-term investors, as it harnesses the power of compounding to grow your portfolio faster. However, if you need steady income for living expenses, you can opt to receive monthly cash payouts instead. The key is to decide your goal up front, whether you want to maximize growth or prioritize regular income. Some investors choose a hybrid approach, reinvesting a portion of their dividends while taking the rest as cash. It's important to review your plan regularly, especially as your financial needs change. Also, be mindful of the tax implications of your choice, as reinvested dividends are still taxable in most accounts. By aligning your reinvestment strategy with your goals, you can make the most of your REIT investments. Now let's discuss the importance of evidence-based investing and how to evaluate the health of your REIT holdings. Evidence-based investing means relying on data and company filings, not hype or speculation. Always cross-check payout histories to see if a REIT has a track record of consistent, sustainable dividends. Look for companies with a history of maintaining or growing their payouts, even during challenging market conditions. Review key metrics like funds from operations FFO, adjusted FFO, AFFO, and payout ratios to assess the health of the dividend. A sustainable payout ratio, typically below 80%, indicates that the company is not overextending itself. Also, examine the company's debt levels and interest coverage ratios to ensure it can weather economic downturns. Don't be swayed by promotional materials or high yields alone. Dig into the financial statements and quarterly reports for a clearer picture. Consistency in performance is a strong indicator of a well-managed REIT. By focusing on evidence and avoiding emotional decisions, you can reduce risk and improve your investment outcomes. Next, let's talk about setting realistic expectations and building a portfolio that pays reliably, regardless of market conditions. Achieving reliable monthly income from REITs requires balance and realistic expectations. No investment is without risk, but by diversifying across sectors and focusing on sustainable payout ratios, you can engineer a portfolio that delivers steady cash flow. Avoid the temptation to chase the highest yields, as these often come with increased risk of dividend cuts or capital losses. Instead, prioritize companies with strong balance sheets, conservative payout policies, and a history of weathering economic cycles. It's also important to monitor your portfolio regularly, making adjustments as needed to maintain your desired risk and income levels. Remember, the goal is to create a stream of income that isn't dependent on market luck or short-term trends. By staying disciplined and patient, you can build a portfolio that supports your financial goals for years to come. Now, let's outline some practical action steps you can take to manage your REIT investments effectively. To put these principles into action, start by enabling dividend alerts with your broker or investment platform. This ensures you're notified whenever a payout is made or if there are changes to the dividend schedule. Next, consider setting up auto-invest features for your DRIP, so your dividends are reinvested automatically without manual intervention. Review your REIT holdings and payout health every quarter, looking for any changes in payout ratios, FFO, or sector performance. If you notice warning signs such as rising debt, declining cash flow, or payout ratios creeping higher, take time to reassess your positions. It's also helpful to keep a written investment plan, outlining your goals, target allocations, and criteria for making changes. By following a disciplined process and staying informed, you can manage your REIT portfolio with confidence. Finally, let's discuss some resources and next steps to help you continue your learning journey. To support your REIT investing journey, keep watching these financial videos for passive income education. This will help you evaluate potential investments and monitor your existing holdings. In our next video, we'll do more research on other areas that can secure your financial future. Be sure to subscribe for weekly breakdowns, actionable tips, and the latest updates on REITs and passive income strategies. Remember, successful investing is a marathon, not a sprint. By staying informed, disciplined, and focused on evidence, you can build a portfolio that delivers reliable monthly income and supports your long-term financial goals. Thank you for watching, and I look forward to helping you on your path to financial independence.